we got monthly numbers out of Capital One and Discover and a few others so far this morning. We'll get them all by the end of the day, but these October numbers are bad. They're really bad, like impressively bad in terms of the delinquency rate changes, the net charge-off rate changes. Like, I try to sort of get away from hyperbole. I try to be more sort of, kind of even-keeled, and it takes more to kind of move me off my axis. But these numbers are bad, period. Give you an idea.
Are you comparing your axis to my axis? I mean, are you trying to say you try to keep it together a little bit more, man? Yeah, but it's like they're almost, if you really look at it without any axis, and you just look at like the straight down move in bond yields, you might suggest that it looks downright recessionary, that data.
Yeah. I mean, look, I think I think it's reminding me more and more of the developments, in 2007, in the sense that, when you see these delinquency rates just basically going straight up, which is what's happening, and now the charge-offs are starting to flow through on the sort of predictable lag. You have to get concerned by that. There's no other way to kind of address it, and that's what's happening. Capital One's numbers are going up like a rocket. Discover's numbers are going up like a rocket. I mean, these are two of the largest card companies in the country, and remember that there is sort of a reflexive function here, which is that once these guys start to get concerned enough about the credit quality outlook, they're going to ratchet down available lines and incremental access very aggressively. And to the extent that it's really card spending that's been keeping the retail train rolling, then that could come to a halt pretty quickly. Not many people follow this stuff that closely, and this is going to become like something people probably will talk about more down the line here, once it sort of percolates out into the market ether. But this is what people should be paying attention to. The example I gave at the conference when we were out in Chicago, was this countrywide framework from back in early 07, when in the first quarter of 07, Countrywide's subprime delinquency book or subprime book delinquency rate was 10%, and that had moved up to almost 24% by the second quarter of 07, and the market kept going up through October of that year. And that's sort of the remarkable thing, right? Is these things happen, people in seats like my seat notice that, and we get very concerned by that, and we try to get people to pay attention to that. But the market doesn't really care until it cares, and usually the market can't see past its nose. So, anyway, so I'm calling it out for what it is. Hopefully people understand what I'm saying, and yeah, we'll just continue to measure and map.
There are so many days in 08 that I was considered wrong because of the daily or 2 or 5 day market move. I mean, so many times. But ultimately, I wasn't the one that was begging for bailouts and that lost everyone's money. There were so many days. I got fired. You called November of 07. This is the highest level since November of 07. All these rate of change metrics were were vividly obvious in November of 07. I got fired by Carlyle for being too bearish about that data. The stock market stopped going up in November of 2007 and didn't stop going down till April of 2009. Okay, so what you see on the screen today, which can be reflected on or commented on, and Neil Howe and I had a wonderful discussion, I thought, yesterday, or I think he's wonderful. What you think of me could be something else, but just contextualizing these moments in short cycle time within not only the social cycle and the social mood and the behavioral dynamics that we have today, what people want or need to believe, can be anything. It doesn't mean it's true. So I never have I seen more rear view looking commentary. Like all the guys with 50-day moving monkey charts, they're back. A week and a half ago, 75% of stocks were below their 50-day moving monkey. I think if you look at the tier one report today, it's like 70% of stocks are now back above the 50-day moving monkey. So they're bearish below the 50-day moving monkey, after 3 straight months of down. Now they're bullish after 2 straight up weeks. It's just useless unless you're taking the other side, right? And I mean big time taking the other side, like, and doing it surgically. Like, again, I can't help but remind people, when you look at the timestamps, like, okay, well, how do I make money on that? It's like, well, you go from 19 shorts to 4 shorts before the CPI report. Then you come into the CPI report with 6 shorts. And then you end the day with 9 shorts. And then today I'll go back to 18 shorts. That's how you do it. I mean, it's called just trading around the risk of the cycle.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.